You often hear where the economists had anticipated a 25% basis point, even higher than that. It remains unchanged. Is this surprising?
Now, I think after yesterday's inflation numbers, Cindy, we pretty much was certain that the Reserve Bank would give us that much-needed, I say much-needed pause on interest rates. Just remember, we've increased interest rates, or the Reserve Bank, 10 consecutive times since November 2021. So that was a headache for consumers paying loans, but of course it seems like we've got a pause on that. I want to get more insight now from Nicky Weimar. She's the senior economist at Nedbank. Nicky, thanks very much indeed for talking to us. I mean, this was really hoped for. We finally see a pause in interest rates, and it's just, incidental that he ends up with that, or we ended off with that question to him. Could we see now a pause in interest rates, a hiking cycle that has come to an end? And he says, well, it's data dependent, so we can't tell for sure whether or not this is a peak in the interest rate. What's your take on it?
I think it is the peak. So I think, it's clear that inflation is now on a downward trajectory. I think the reason the Reserve Bank will be hesitant to say something like, we're at the peak is because things can change very quickly and very unpredictably, especially in a country like South Africa. You just think of the rand and where we've experienced the rand this year. We've experienced it at 17 to the US dollar to over 19 to the US dollar. And in the space of one or two trading days, the rand can gyrate dramatically. So given the volatility of our currency, given the unpredictability of load shedding, given the fact that we know that it has an enormous impact on food prices in particular, I think that is the reason why from the governor's perspective, he can't just say this is the peak. There are these incredible uncertainties surrounding the inflation outlook, and therefore he has to hedge his bet. But I think if we assess the situation from Nedbank's perspective, to us it appears to be the peak or exceedingly close to the peak. It's not uncommon that they can pause and hike again. That's not impossible by any means. It has happened in previous cycles. But I think that inflation will now start trending down in a more meaningful way. And I think the last set of numbers in inflation was very encouraging. And if you look at the Reserve Bank's own forecast, they've revised their inflation forecast down. It's a touch, it's only slightly, but nonetheless, I think it's moving in the right direction.
And that's what it's all about, isn't it, Nicky? Because one begs to ask the question, has the Reserve Bank's aggressive, almost relentless take on hiking interest rates worked? I mean, it's a very difficult thing to answer because there's just different components to it. But nevertheless, we hear today the governor pauses on interest rates after giving us that relentless hiking cycle. Do you think it's worked to some degree on inflation?
Well, I think it certainly worked. I mean, monetary policy is now extremely restrictive as far as we're concerned. The Reserve Bank, for the last time at the last MPC meeting in May, said that now finally they consider monetary policy restrictive. And our view, it was actually restricted before that. We do work for banks, so we have got exposure to some of the strain that consumers come under as interest rates go up. So perhaps we called it restrictive too early. But we are of the opinion that monetary policy as it stands is restrictive. And does it work? Yes, it does work. It signals the intent of the central bank. It also signals a certain inflation expectation, the willingness of the central bank to defend inflation at a lower level. And it changes slowly and gradually the behavior of individuals, of unions, and of companies when it comes to pricing. It doesn't do it immediately, and it doesn't do it without pain. And what we have experienced over the last year is undoubtedly painful. As you've mentioned, it's a 475 basis point hike in interest rates in cumulative terms. That takes a lot of money out of your pocket at the end of the month. And that simply means that you're far more price aware. And that price awareness doesn't just end with the consumer. It ripples through to companies. They start to think a little bit more about what can they absorb in terms of cost. When they pass it on to the consumer, there is the risk that it can affect their sales volumes. And then finally, also, it eventually affects unions as well. Because if the economy slows down, which is what higher interest rates do, there is always the risk that it can affect wage growth and that it can affect employment.
Well, I mean, let's just unpack that a little bit. I mean, you used the word in the words of the governor, we've reached restrictive territory. And what that basically means is that interest rates get so high that it stifles the economy and the consumer. I would imagine there's some breathing space now, because we know as businesses, we know as consumers that we're at pause time now. Do you envisage this economy sort of opening up a little bit? Much needed opening up is needed because you want to get things going on the consumer and business front. This might be a significant day to get things back on track. Perhaps not overnight, but it's a start, isn't it?
It's a start. I think you must understand that interest rates hit with a lag, right? So we are only now going to start feeling the effect of last year's interest rate hikes. The hikes we saw during the course of this year, the cumulative effect of that's probably going to hit us sometime next year. So interest rates, unfortunately, the pain, it takes a long time to have an effect. Anything in the case of South Africa, between 12 to 18 months from the point where you first start hiking interest rates. So we are at that point, at that juncture where it's affecting the consumer, but the impact continues to build. So even though the Reserve Bank is pausing now, it doesn't really stimulate activity until you start cutting.
Yep.
So as long as they keep interest rates at current levels, it is restrictive. It's not like the consumer suddenly gets a breather. Where we do think the consumer will get some relief is as inflation comes down, and particularly as this incredibly destructive form of inflation we've had, which has been fuel and food prices, and more so in 2023 than in 2022, we've had food price inflation at double-digit rates. Now, if food and fuel prices continue to fall, if inflation continues to come down, then your real income starts to improve. So falling inflation is what will make the difference to household income and might make it a little bit easier for them to cope with higher interest rates. But higher interest rates will continue to exert pain until you actually see a cut.
So on that note, Nick, and before I let you go, when do you think we will be at a point in the coming months, if not years, but I would imagine coming months, where that bond that one is paying starts to shrink a little bit? In other words, more disposable income, we are likely to see an interest rate cut. When was that likely to happen, from what we heard today?
I think they're going to pause for a while. I think they're going to stay near this, what we now consider the peak, which they are still not calling the peak. So let's be clear on that difference. I think they'll stay there for a while. They'll want to be very certain that inflation is heading towards 4.5% and that it's heading there for on a sustainable basis. One of the tricks at the moment is very simply that we've got very big base effects in the inflation numbers. You remember last year, the world over, we saw oil prices accelerate off a low base. We saw food inflation accelerate off a low base. And now we are seeing the benefit of that base reversing. So we're working out the rate of change in food prices off a much higher level last year. Only in the second half of this year will that base dissipate. And then we'll have a true sense of where inflation is actually settling, both globally and locally. And I think the Reserve Bank will probably want to wait and see what that looks like. And so for us, they'll keep interest rates at this level probably for the rest of this year. And where will that point be, in our opinion, where the consumer can expect some relief is probably going to be early next year. That's where we start to see them cutting interest rates.
All right, we'll leave it there. Well, thanks very much indeed, Nicky Weimar, for those insights. He's the senior economist at Nedbank. So, Cindy, there you have it. I mean, it took 10 consecutive hikes to get where we are. As I said, from November 2021, we all experienced hikes on the interest rate. So as it stands, just to summarize for you, the repo rate, which is the rate at which the Reserve Bank lends banks money, that's 8.25% as of today, staying the same. Your prime lending rate, in other words, the rate that they consider when you're applying for a home loan, that prime rate is now 11.75%, again staying steady. It's a pause I think we've all been waiting for.
Much needed pause indeed, but he also mentioned that salaries and wages for this current financial year had come out lower, that the trajectory is expected to increase, probably more strikes and wage negotiations are coming forward in 2025. But as you said, I mean, it's quite a welcomed relief that things have remained stable and unchanged. So thank you very much, Devan. Much appreciated. That's eNCA business editor Devan Murugan speaking to Nicky Weimar, the economist at Nedbank, and breaking down the numbers for you. Of course, that's something that we'll be watching very closely. So what else?